Hey guys, hope you and the families are doing well. In this short video, I'm going to teach you a very simple swing trading breakout setup from continuation type bases, which will oftentimes look like a flag, a pennant, or a Davis box. Now I'm going to give you some very simple guidelines to follow, and then I'm going to give you some simple criteria that you can apply to screens to be able to quickly and efficiently find these type of setups. Now to illustrate the setups, I've got 4 charts loaded up from 1981 to 2024 just to illustrate this type of setup is absolutely timeless. It happened decades ago, and I think they will continue to happen many decades into the future. Market Surge are today's video sponsor. They are my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, then you'll find a link to that in the description and the comment section below. So let's start off with some simple guidelines that you can apply to help find this type of setup. So what are those simple guidelines? Well, first and foremost, we want to see that the stock is in a powerful uptrend and showing relative strength versus the applicable index, and even better if it's showing strength versus its group as well. So ideally, we want to look for the strongest stocks in the market and in the strongest groups of the market. It finds support in the context of that powerful uptrend near its 10-day EMA or 21-day EMA or 50-day simple period moving average. So those lines on my chart, black line is going to be the 10-day EMA, the blue line is going to be the 21-day EMA, and the purple line is going to be the 50-day simple period moving average. Undercuts and shakeouts are fine. So let me give you an example. This would be a shakeout AMD over here in 2019. This would be what I call a gap down reversal bar. So it kind of undercuts the prior closes here, it undercuts, opens here, then pushes up underneath its 21-day EMA. They are fine, and they are actually very constructive to see when you see those shakeouts and you see those type of undercuts. It forms a tight relative candle or candles on one or more key daily moving averages. This could be the Minervini point. Volatility tends to contract before you then get the breakout. That's same with Toby Carabell. I've done a couple of videos on the channel. You may be familiar with his NR7 or 2-bar and 3-bar NR, looking for periods of tightness, but I'm trying to give you the moving averages just as useful reference points for where you're looking for this type of behavior. Then you can target with a buy stop limit order or an opening range breakout, keeping risk less than the 20-day ADR percentage, which is going to be here. Now this 20-day ADR percentage is the average daily percentage range excluding gaps of the stock over the last 20 days. So that's the 20-day ADR percentage. Now why is that useful? Because if I'm targeting these, if I'm doing a buy stop limit order or say an opening range breakout, I like my initial stop loss to ideally be less than the 20-day ADR percentage. What you'll see is stocks have different characters, so their ADR percentage is going to change. So IBM is going to have, say, a smaller 20-day ADR percentage relative to a really hot momentum type stock. So I like to think about risk relative to the stock that I am trading. So if it's a really slow stock, I generally want to keep risk tight relative to that. If it's a quicker stock, then my stop loss can be wider, but I still want to keep it tight relative to, say, the stock's own character and how fast or not the stock is. Now, simple ways that you can screen for this, and then I'll go into some more of the subtleties of the setup. Simple ways to screen for this setup. Well, if you take a look here, what do you notice? So the point of your screening is you use criteria to efficiently find the type of setup that you are looking for. So as you look at all these setups here, we could look at KEX back from 1981, we could look at AMD from Feb 2024, we could look at Cirrus Logic from 2010. What do you notice the commonalities are? Well, they're all above their 50-day simple period moving average. They're also, you can't see it on this chart here, you can just see it with the AMD here, okay, but they're all above their 200-day as well. So the intermediate term and the longer term trend is up as defined by the 50-day and the 200-day. So that would be quite a good criteria to be screening for. So we'd like to see price above the 50-day and the 200-day simple period moving average. This is about you building mental representations in your own head for what does a fantastic setup look like for you in terms of your own playbook. If you find actually the 10 out of 10, the 9 out of 10 setup, actually when they set up from these continuation type bases, which could resemble flags, pennants, Davis boxes, wedges, whatever it may be, if you notice that actually a 9 out of 10, a 10 out of 10, they're always above their 50-day and they're always above their 200-day, well, you want to focus on trading the 9 out of 10s or the 10 out of 10s. So screen for that. So screen for prices above the 50-day and the 200-day simple period moving average. Now you probably want some liquidity in there as well. So you could search for 50-day average volume to be greater than, say, 100K. If you're getting a lot of results, maybe you want to increase that, 250K, 500K, maybe greater than $1 million if you want the really liquid stocks. Or my preference would actually be using a 50-day average dollar volume. You could set that, I'd say, a minimum of 5 million. Ideally, I like to be trading the more liquid stocks. So you actually may want to find, if you're getting a lot of results, you may want to increase that to 25 million, 50 million, maybe greater than 100 million. And then you can simply filter by the largest percentage movers over a given time period. You could do 1 month or 3 months, maybe you want to do 6 months. Okay, but you could look for, okay, what stock has made the largest percentage gain over the last 1 month? So what are you trying to look for? Well, you're trying to look for this, a stock that's made a powerful uptrend like this, and potentially it's up 30%, 50%, 70%, 100%, whatever it may be. You'll see the strongest one first, and it's above the 50 and it's above the 200. So what are you simply screening for and filtering for that? Well, you're looking for a stock that's in an uptrend above the 50, above the 200, and in terms of the last 1 month or 3 months, it's just made a large percentage move, and then we're looking for it to tighten into key moving averages. That could be the 10-day, the 21-day, or the 50 period. So really, it's only 2 criteria. It's not rocket science. You're just trying to efficiently identify this type of setup and know, what does that setup look like? What are the criteria to help me efficiently identify that setup? Now, can you add a couple of things in there? Could you add, say, you want the 20-day ADR percentage to be greater than 2%, 3%, 4%? If you like trading the quicker stocks in the market, you may want to go, yeah, I want it to be greater than 3.5, 4%, and actually I want that 50-day average dollar volume to be greater than 25 million, 50 million. So then you're looking for a stock that's in a nice uptrend, is above the 50, above the 200, nice and liquid. Say if the 50-day average dollar volume is greater than 100, is greater than 100 million, and it's got a 20-day ADR percentage greater than 4. Okay, now your universe of stocks is really going to be narrowing, and you're going to try and focus in on, say, the AMDs when it's basing like this, AMD when it is basing like this, potentially Cirrus Logic when it is basing like this. So it is not absolutely rocket science in terms of the kind of general guidelines to be looking for this setup, how to simply identify these setups in terms of some basic screenings. You can do that on, say, My Software, you can do it on TradingViews, you can do it on TC1000, you can do it on Market Search as well, but it's not rocket science to identify these. Now, a couple of nuances that I will go into is I call the really tight bar a trigger bar, because that bar there is the trigger for me to do something. So I just want to spend a little bit of time on that. Again, this is about building those mental representations for yourself. On the trigger bar, note how it is very close in terms of the proximity to one or more key moving averages. What you actually see in each of these instances is it's right there on its 10-day EMA. It's very close to the black line. Here it's kind of straddling the black line there, the 10-day. Here with AMD, it's kind of straddling the black line there. Here as well, it's kind of just above the 10-day. So I don't like looking for this type of setup when it's extended from the 10-day EMA. The 10-day EMA for me is a nice reference point. So here you could go, well, this is a really, really tight bar. Look at that. Look how tight it is. Well, it's extended from the 10-day. I'm not looking for it there. I'm looking for that kind of basing action to build the flag, the pennant, the Darvis box, the wedge, whatever it may be. And the stock is then sitting on the 10-day EMA. So this is a no-no. This is a yes. That's a really good set. That was supposed to be a tick. This is a yes. If you look at, say, Cirrus Logic here, this is when it gets really nice and tight, and we'll come on to the volume in a minute. Here, note that it's extended from the 10-day EMA. This is a no. I'm not looking for it up there. I want to see that continuation base. I want to see price tighten into the moving averages. Here as well, you could say AMD, well, that's a pretty tight inside bar, isn't it? Well, it's extended from the 10-day EMA, and it's not built a proper basing pattern yet. So I want to see that period of consolidation. Maybe it's 2 weeks, but ideally it gets to kind of 3 weeks, 4 weeks, and potentially beyond. What you'll tend to notice is when you get that really tight bar sitting on one or more key moving averages, here we're really looking at, say, the 10-day EMA, is you'll see that oftentimes it is the lowest volume bar thus far in the base, or very close to the lowest volume bar thus far in the base. I haven't got the average here. I like to have the 30 bar, the 30 line moving average for the volume on my main charts. I've just kind of split these to help illustrate the points, but I like to see that relative dry up in volume. So if you take a look at KEX here back in 1981, it's the same principle as looking at Cirrus Logic in 2010. What do you notice? The volume really dries up on the tight bar while it's on the 10-day. The volume really dries up on the very tight bar on the 10-day. If you look at AMD here, volume really dries up to one of the lowest volume bars, if not the lowest volume bar in the base, when it's really tight on the 10-day. Same here with AMD in 2019 as well. Not quite the lowest bar. It would be this one here, but it never moves through the high of that bar there, and it's kind of a little bit of a short base as well. But then you're starting to build out the mental representations, and you're going, okay, what does a really good setup look like? What is a fantastic setup? What is a 9 out of 10, a 10 out of 10 setup? It's this criteria, this criteria, this criteria, and this criteria. And anything that doesn't have that criteria, well, it's not a 9 out of 10, and it's not a 10 out of 10. So this is the type of things to be ingraining, and then you can start going a little bit further down, say, the Alice in Wonderland, the proverbial Alice in Wonderland rabbit hole. And then you can start understanding, well, what does it mean from a supply and demand perspective? When you get a lot of tightness in price, a really tight bar, and the volume is drying up. Well, supply and demand is supply and demand. Buying and selling is buying and selling. Accumulation and distribution is accumulation and distribution. It doesn't matter if it was 1981 or 2024. It's the same concept. It's the same point from a supply and demand perspective. This really tight bar, given the context of how this is based and pulled into the 10-day, and here with the volume drying up, is indicating there's very little selling. There's very little supply that is now coming to market for this stock. So what we're then looking for is, now that equilibrium has been built, the sellers have really dried up. We're now looking for that continuation to the upside. So what you then normally see on the breakout for certainly the better ones is, note the next bar, the pop in the volume. You can really see it here with Cirrus Logic. You can really see it here with AMD, and with AMD down here in the bottom left as well. Note the pop in the volume. That's a lot of buying. That's a lot of demand shoving up. That's fantastic to see. So in terms of then entering the position, I like doing buy stop limit orders or opening range breakouts. So I've put the dates here, so you can go and study these ones yourself. I will just finish with kind of what I was referring to here, kind of undercuts and shakeouts. If you look at AMD is probably a really good example. This bar here, note this is a big shakeout. The prior closes up here, it gaps down, it opens here. So if you were a trader and you had bought this, maybe you've been long somewhere in here, and here, and here, and here, and maybe you bought it on a pullback to the 10-day EMA. This bar here, it's either probably panicked you out on the opens. You're like, this thing is gapping down big below the 20. I'm out. Or potentially you raise your stop loss somewhere in this vicinity and your stop has just been hit. So those shakeouts, those gap downs, undercutting say a key moving average or undercutting the last week, 2 weeks of price action can knock those stop losses out, and actually they're really good to see if it then subsequently sets up there afterwards. So hopefully that short video there was useful for you in terms of thinking about this. I refer to these as trigger bars, but this is where you're looking for a continuation type base to form. Could resemble a flag, a pennant, a Davis box. You're looking for it to get nice and tight around one or more key moving averages. 10-day and 21-day are going to be the most common. Much bigger base, you can get the 50 in there as well, get a really nice clustering. Look for the tightness, look for the volume to be drying up, look for the leadership versus both the market and also the stocks group. Think about the initial risk relative to the 20-day ADR percentage, and then this here is a very, very simple way to be screening for these types of setups. It is not rocket science. So that is it, guys. I will wrap it up there. Hopefully you've enjoyed that short video on how to trade this type of setup. Thank you for all the support on the YouTube channel, and I look forward to seeing you in a future video.